Welcome, mums, to lesson 2 of module 3, where we are taking control of your credit cards. Okay, to set the scene for what we're going to learn in this lesson is a quote from Maurice Ouellette, I think I pronounced that last name correct, who is not actually anyone from the financial community. She is a Canadian actress and businesswoman, but I love this quote about credit cards because I think it epitomizes everything that I think women should feel about credit cards. It says, all I need are chocolates, credit cards, and stilettos. I think it's great because it's important to realize that you don't need to give up everything that makes you happy as a woman or as a mother when you decide to be or live a financially wise or financially responsible lifestyle. A lot of people would have you believe that doing that means you need to budget and give everything away and cut up all your credit cards and stay at home, with the curtains drawn and never go out and spend money again. But the reality is that you don't need to do that. There are just certain things that you need to understand about credit cards and their use, how they work, and how to use them to your advantage. And then you have the power when it comes to using them as a financial tool, rather than you being trapped by an alternate use for them, which sees you basically just accumulating debt and getting stuck in a debt repayment cycle. So the first thing I want you to understand about credit cards is credit cards are a financial tool, not a financial crutch. They are a financial product. Money is made when you pay fees and interest to the bank. So they're a product the bank sells you. Money is made by the bank when you pay fees and interest. If you don't pay fees and interest, then you're using the product as a tool for your own advantage. So most people get their first credit card as a young adult, some even younger as a teenager, and there's really no financial education that goes with using a credit card optimally. We get it, and then we buy things. And we're too young to care at that point about money skills and money management, and by the time we do care enough to start learning, our habits with credit cards have already been formed. So it's really important to reframe your understanding of a credit card. And that is this: they allow you to pay for your expenses and the general cost of living with the bank's money. You have the advantage of earning rewards points to help reduce the cost of your future expenditure, like travel, as well as keep your money as savings, earning interest in the bank instead of funding your expenses. Now, a recent study I came across by Fox Symes this year revealed that around 58% of Australians can't afford to pay off their credit card in full each month. And this is where the banks make their money with cards. So it's important to remember that a credit card is a financial product. It's offered to you at a cost. However, if you understand the terms of the card, then you can deal to your advantage. The first part of understanding the terms of the card is understanding how credit card interest works. Now, a lot of people think they understand how credit card interest works, but in reality, there's a few little things that they don't understand. So the first thing to get is that there's 4 different types of interest. There's the purchase rate, which is the amount of interest you'll pay for buying things on the card. There's the cash advance rate for any money you draw as cash from your card, if available. There's usually an introductory rate. So some cards will offer a lower interest rate when you join or take out the card, which then reverts to a standard rate after a set period of time. And finally, there is a balance transfer rate. So when you transfer the outstanding balance from one card to another, this is the rate that they offer. And these are often available at lower rates for a set period, as low as 0% commonly, and then they revert to higher cash advance rates. The next important thing to understand about your credit card is the interest-free period and how it works. So there's 3 things you need to know. How many days or interest-free days your card usually has. Usually it's around 44 to 55 days. That's the number of days that your card is interest-free. Then you need to understand or need to know what your statement period is. The first and last day of your statement period is shown on your monthly credit card statement, and it is not the first of the month and the last of the month. It's not that by default. It could be that, but it's not that by default. It doesn't work off a calendar month. Your statement period is unique. And the third thing is when your payment due date is. So that is usually 14 to 25 days after the last day of your statement period. And this due date can also be found on your statement. So pull out a recent credit card statement and look at these 3 things. The 55 days, if you have a 55-day statement period, or interest-free period, I should say, the 55 days starts on the first day of your statement period and ends on the payment due date. So the 55 days interest-free does not mean that you have 55 days interest-free on every purchase you make. The actual interest-free period for a particular purchase depends on when you make that purchase within your statement period. So I know that's a little confusing. So to illustrate, I've put together. So let's look at this example in order to understand the interest-free period a little better and really grasp how many interest-free days you have on a purchase, depending on when you make that purchase in your statement period. So let's say you have a credit card with up to 55 days interest free. So your statement period in this example starts at the beginning of the line on the 5th of July and it ends on the 3rd of August. And that is illustrated with the dotted pink line, which is equal to a 30-day period. You then have 2 weeks until your payment is due on the 28th of August, which is the other end of this line. Now that entire period is a 55-day period, and that is your interest-free period. So let's just go from left to right. On the 5th of July, your statement period starts. On the 3rd of August, your statement period ends. And on the 28th of August is your payment due date for the purchases made within that statement period. So let's look at a purchase example. So if you purchase a new TV on your credit card on the 31st of July, you will have 28 days to pay it back in full without having to pay any interest. So purchasing the TV on the 31st of July means you purchase the TV within your 30-day statement period. So between the 5th of July and the 3rd of August. Now the number of days between the 31st of July and the 28th of August, which is your payment due date, is 28 days. So you will have 28 days to pay that purchase back in full without having to pay interest on that purchase. If, however, you ended up purchasing the TV on the 10th of August, this purchase would then actually fall into the next statement period because your statement period closes on the 3rd of August. So you would have 48 days to pay it back in full without having to pay any interest by the next payment due date. So as you can see, when you make the purchase within your interest-free period determines how many interest-free days you actually get on that payment or on that purchase. So your key takeaway here is the interest-free period only applies if the outstanding balance on the card is paid by the payment due date. So it's really important to understand that even if you have a 44 or a 55-day interest-free period, if you're not paying off your balance in full at the end or by your payment due date, then any purchases you make in the subsequent or following statement periods will be charged interest. There are no interest-free days. So that is one thing to understand about your card, because it's really important to know when you are and aren't paying interest. And a reason that it's really important to know this as well is that a lot of people assume that by religiously paying off their credit card at the end of the calendar month, so, by paying your balance, the outstanding balance, whatever it is on your card as at 30th or 31st of the month, that you are paying your card off in full each month. But the reality is you actually may be missing out on your interest-free period, because as I showed you before, your statement period doesn't necessarily match up to a calendar month. It could be middle month to middle month, or end of the month to the end of the month, the next month, but not quite the end of the month. So you really need to be aware of what your statement period is and when your payment due date is, to make sure you're paying off your balance in full by that date, not just necessarily the end of the month or the calendar month. So now we understand about how credit card interest works, and we understand how the interest-free period works. So how do we use a credit card wisely? Some of this is self-explanatory, but it needs to be reiterated because people still don't adhere to these basic ways of using the credit card. The first thing you need to do is pay your balance in full every month. This way you avoid interest altogether and you avoid late fees. So paying your balance in full every month essentially means you use the bank's money to make your purchases or to fund your living costs, whilst your money sits patiently waiting in a bank account earning interest to pay off your credit card bill by the payment due date. So you do not pay interest on those expenses, but you're also able to earn interest on your own money over that time because the funds have been sitting there accruing interest for yourself rather than the bank. The next one is to stop making cash advances. It's really tempting to use your credit card as a debit card, but don't. If you've got a debit card, use your debit card to take cash out. Using cash advances is really one way to rack up the interest costs and the fees that you pay on your card. Reconsider the need for multiple credit cards. Do you really need 2 or 3 or 4 credit cards to do what you need to do when it comes to using a credit card? Probably not. And the fact that you have more than one says that you either need more than one because you have potentially maxed out some of the others, or you like the flexibility of being able to put more than what you budget for on your credit card. So reconsider the need for multiple cards. Reconsider the credit limit you have. Do you need it? If you have a $20,000 credit limit on your credit card, do you really need that much credit? Is the temptation of having that much credit an issue for you? In many ways, it's actually a risk because having that much credit there exposes you to higher liabilities in the event of fraud. But the other thing is, it is a temptation, and it can be psychologically rewarding to see a credit limit of $20,000 there. Even if you do know that it's not your money, the mere fact of having it there gives you a sense of financial means that you do not actually have, because remembering that money is not yours. So reconsider the credit limit you have and think about something more realistic. I do believe having a bit of a buffer in there is a good idea, but I think it needs to be closer to what your budgeted monthly expenses equate to. And then the last one is be mindful of the annual fee and ensure you budget for it. So if you're applying for a platinum credit card with a $500 annual fee, that's $500 that you need to find to cash flow that having that card. So it's not an insignificant amount of money. Whilst not significant, it's not insignificant. So it's something to be mindful of and to factor into how you use your credit card. Now, if you use your credit card for household bills, as I mentioned earlier, that's something I do. I do it because we utilize the Qantas Frequent Flyer program and it works for us. But if you are using your credit card for household bills, make sure you're on top of your budget. So make sure you're aware of what your planned expenses are so that you know what expenses you can put on your credit card and what expenses you should not be putting on your credit card. Set up your bills as direct debits on your card and leave it at home. There's no need necessarily for you to take it out. If it is a temptation for you to spend on it over and above what you've budgeted, but you do want to take advantage of, those rewards programs associated with earning points via payments on credit card, then you can still set your bills up as a direct debit, but just leave the card at home so you can't actually make any additional payments on it. Then ensure that you're keeping funds in your bills account. So from Module 2, where we talked about cash flow structure and automation, make sure that you're keeping sufficient funds in your bills account to cover the budgeted expenses you're paying on the credit card. So that at the end of the month, when the bill comes through, and at the payment due date, you have the money that you need sitting in your bills account to pay off the card in full. And then pay it off on the payment due date from the bills account, or better yet, set up a direct debit from this account so it's done automatically for you each month. If you know what your payment due date is, then that can be an automated transfer. Now, I personally choose to use credit cards for the following reasons. One is convenience. There is a convenience about using a card to pay for some of your household expenses. So, for one, groceries. I pay for groceries on the credit card. We pay for the majority of our expenses on credit card. We do that by direct debit, payment setup where possible. Or if we're at the shops, as I said, at the supermarket, I use the groceries. I use the credit card to pay for the groceries. The reason that I do that is for rewards points. We've worked out a system that works for us, and that system ultimately helps us pay for some of our additional expenditure throughout the year on things like travel and accommodation and family holidays. So those 2 points working together, those are two of the biggest reasons why I choose to use credit cards to manage the cash flow of bills in our household. There's another 2 reasons why. One is it does help to build a bit of credit history. So if you've applied for a card and you use the credit in a sensible and financially responsible way, and you have a good track record of paying off your balances on a monthly basis, then you do create, by the sheer act of utilizing a credit card, a good credit history in a sense. And the last one is insurance protection. I mean, it's something people don't think about, but if you have, and it only comes with certain types of cards, but things like travel insurance are built in to those products, to those cards. So if you're paying for a family holiday on credit card, and you put the expenses associated with that trip on the card, then you automatically, in a lot of instances, qualify for a good amount of cover for travel insurance and medical insurance costs whilst overseas. So it's important to check that those policies are actually sufficient for your needs, and you do that by contacting the credit card company and asking them for a PDS on the travel insurance that they offer as part of the rewards program. program attached to your card. But realistically, I mean, for a family of four, say, looking at travel insurance or a comprehensive amount of travel insurance, you're looking maybe at $200, $300 or $400 or more. And if that's an included reward or part of the program of your credit card, then that's $200 or $300 or $400 that you save per annum on a family holiday. So there are benefits to using cards as part of managing your household cash flow. You just need to be aware of how the card works, what's included, when you need to pay it off by, and make sure that you're not spending above and beyond what you've budgeted for on the card. Use it as a tool. So the real key, or the biggest takeaway, as I said, in terms of getting a grip on credit cards, is to change your mindset about them. So see them not as an additional source of funds for yourself, but rather a tool for managing your cash flow better. So people often make the mindset mistake of seeing their financial position as being the sum of their personal resources, like their cash flow, and then their additional funds, being their credit card. But the reality, however, is that their cash flow has to support their spending on the credit card. So the spending that you make or that you place on your card is actually part of your total spending. So it's not additional spending, it's part of what you've budgeted or planned for. And then if you think of it that way, you will always have the resources to pay it off, as opposed to it being additional funds that you've spent somewhere along the way that you haven't paid off or that you haven't accounted for, that requires you to pay it off now. So the activity that I have prepared for you to really solidify coming to terms with your credit card is do a credit card audit. So use the credit card audit form to complete the audit. And this will help you understand your credit situation better and ensure you know your payment due dates. So get familiar with your credit card by using the credit card audit form, and that will really help you understand how you can be using your cards as part of managing your financial cash flow. All right, next up in lesson 3, we're going to look at financing a family car. We're going to look at some of the common ways this is done, the benefits or the advantages and disadvantages of various options, so that you can get your head around it, because it's a common issue for families, and it's one that usually involves the application of debt. So see you in lesson 3.